Hey, Bowtie Nation, Joseph Hogue here, coming to you a little bit late, but as always on Monday, 9 a.m. Eastern, getting you ready for the week with a little bit of stock market news, strategies, really the trends that you need to know about, and really how to invest in this market. Got a great live stream plan for you this week. I see a lot of all you out there in the Bowtie Nation there in the comments. Love seeing everybody there. Ambrose from New York, always good seeing you. David, good seeing you there. Stocks in the S&P 500 and across the indexes are down for 7 straight weeks, which is almost unheard of, right? Longest losing streak since 2001, and a lot of oversold conditions building, indicators flashing that we should get some kind of a relief rally, but it just hasn't come, right? So it just proves the old saying that the market can stay irrational longer than you can stay solvent. So in that just means that if you are using a buy the dip strategy, you need to use a smart one. You need to understand how to buy the dip, when to buy the dip, and and how to work that to avoid going all in cash while the market is still dropping. So we're going to get right into that, as well as all the stock market news and trends, everything I'm watching for this week, as well as the stocks I'm watching for this week. I do want to invite you to get a free report I put together with the Motley Fool. It's the 7 stocks I'm investing in, even no matter what, the long-term growth stocks. I'll put a link there in the chat to click through that. It's totally free, no obligation. I'll put the link in the description as well. Motley Fool is going to send you some emails asking you if you want to sign up for the portfolio advisor. I use the service. I like the service as far as some of the stocks they recommend. I don't invest in all their stocks, but basically it just helps support the channel. So I appreciate it. But you get that free report. It's totally free, no obligation. You don't have to sign up for the Motley Fool or anything, and it makes keeps the lights on around here. Keeps my kids fed anyway. But let's get to it because, like I said, we do have an important topic I think this week to cover buy the dip strategy. And I'm actually going to share two buy the dip strategies because what ends up happening is let's rewind. Over the past since 2009, S&P 500 stocks in the S&P 500 have been up 800%. And besides just the length of the bull market that we went through, the resiliency and almost the straight up nature of stocks was just very rare. It was rare for stocks to be down more than 5% even, which usually we get 5% corrections 2 or 3, 4 times a year. We even get 10% corrections on average two times a year, 10% corrections. And we just did not get that over the last 10 years. So a lot of investors really have always been investing on that immediate buy the dip strategy. Immediately as stocks go down 2 or 3 or 5%, they're buying the dip and going all in with all their cash. And it's paid off over the last 10 years, right? You've made a lot of money because stocks just did not go down for any kind of extended period of time. Well, obviously that's changed in 2022 and you need a better buy the dip strategy, right? Because otherwise what happens is stocks go down 5%, you put all your cash in, you're all in with your cash, and they go down another 15% or another 20%, and you've lost out on all that money. So what we want to do here is share 2 buy the dip strategies. One is one that I use, one that I've shared here on the channel, and I just want to kind of reiterate it, how that works and how you can use that to not necessarily time the market, but make sure you have cash available, to buy in at lower prices as they come along and when they come along. The other one is by Michael Edison. He's the former chief economist at the NASDAQ Stock Exchange, as well as the chief risk officer over at the University of Chicago's Endowment Fund. Put together a buy the dip strategy that was actually shared in the Wall Street Journal over the last week that I saw, that I wanted to share that with you. So the first one that I want to share is my strategy. Really simple, actually, just picking a set formal points in the index, right? And it's so I like to use the S&P 500 as the market index, that broad market index, rather than maybe one of the smaller ones like the Dow or the Nasdaq. You can use any index, really. You can use the Russell as a set point. It doesn't mean you're investing in that index. You're just using that index as a point, as a marker to when you're going to be buying in and buying on the dip, right? So you set formal markers. For example, right now with the S&P at 3,900, it's about 20% down from the peak. Peak was about 4,818 last November. You're going to set formal points, and I would set mine at like 3,500, maybe 3,000, and 2,500. Okay, so that would take the S&P 500 at that first one, 3,500. That would mean 27% down from the peak. The second marker there, 3,000, would bring it 37% down from the peak. And then the final one, 2,500, would be 48% down from the peak, right? And why I picked those aren't set in stone, not by no means, but why I picked those is recessions or stock market crashes or bear markets that haven't been followed by a recession have typically been between 20 and 30%, right? Now, the ones that have been followed by a recession, so the bear markets where we end up going into a recession, then those have actually been between 30, 35 to 50%, right? So you do want to leave yourself open to be able to buy in at the lower prices if we do get a bigger bear market, which I do believe we will see this time around. A couple of reasons for that. One is, I still believe we can get some kind of a relief rally here into the summer. Stocks are very oversold, on a near-term basis. So I do believe we get some kind of a relief rally into the summer. But then as we head into next year, there is no doubt in my mind, and almost 100% chance, priced into the markets really, that we do get a recession next year, even if it's a little bit later next year. Nation, there has been no other time in history where we have had such low unemployment, but such high inflation, and where we have been starting from a point where the Fed needs to pull back so much stimulus that it's pushed into the economy over the last 5 years. Over the last 5 years, the Fed has pushed $5 trillion into the economy through its balance sheet, right? Through buying bonds, through buying treasuries, and buying mortgage-backed securities. It's bought $5 trillion of that and pushed that cash that it paid for those bonds out into the economy. It now needs to bring that back, okay? The Fed cannot have a $9 trillion balance sheet, right? So it's letting almost $100 billion of those bonds roll off its balance sheet every month. So, right, so that's going to create some kind of imbalances in the market as far as bond pricing, as far as stimulus to the economy. It's also raising interest rates, right? It should have raised interest rates long ago, but it's just now starting, and it's having to be aggressive, right? With inflation at 8% on a year-over-year basis, the Fed has to be aggressive, pushing interest rates up 0.5% each meeting. Some people think they're even going to put in a 75 basis points or 0.75% increase here in one of these meetings coming up soon. So the Fed has to be extremely aggressive to be able to fight this inflation, right? It's something we haven't seen since the 70s. And in the 70s, we didn't have this paradox of employment, right? Employment is extremely low right now, which means the Fed can be as aggressive as it needs to be. The Fed only has two mandates. The Fed only has to do two jobs: keep inflation low, but keep the unemployment rate low as well, right? Well, it doesn't have to worry about the unemployment rate because the jobs picture is so good. So it can singularly focus on that inflation rate by raising rates aggressively. That's what it's going to do. And I do believe that's going to push us into a recession over the next year to 18 months. And I think that's why you see those lower prices on stocks eventually. After this summer rally, I do believe we hit those lower prices. So anyway, again, back to this buy the dip strategy. This is just going to make sure that you keep some cash back to invest at those lower points. If you do have those 3 points, 3,500, 3,000, and then 2,500 on the S&P 500, at each of those points, you go in and say, okay, you know what? I've got my cash set aside. I've got some bonds in my portfolio and commodities and other assets, real estate and non-stock assets. At these 3 points, I'm going to take some of those, especially some of the cash, maybe a third of the cash each time, and I'm going to put it into stocks. I'm going to buy in at these lower prices, just in case the market does recover from there, right? Just because you've got those 3 points on the S&P 500 that you're watching for doesn't mean the market is going to stop right there or keep on going and hit each one of those and then go up. Okay, we're just using those as good markers, 27%, 37%, and the 48% down from the peak as markers for when we want to invest. Instead of that, other than that, you're going to be looking at the market every single day wondering if you should invest now, buying the dip every day. You're going to be cash all in within a week And again, the market's going to keep falling lower, and you're not going to be able to take advantage of that. It's going to be very painful, frustrating watching the market keep on falling, and you don't have any more cash to invest. So this is just a great strategy to formalize that buy the dip strategy, to keep that discipline in that strategy, and make sure you have enough money to invest at each of those points as the stock market does fall further. Now, a lot of you lately have been asking about margin. Should you, if you're already all in cash on margin, should you start using already all in on cash? Should you start using margin? And I would not. I would not start using margin, especially not yet. We are just now 20% down from the peak on the S&P 500. Again, prior crashes, prior bear markets that have ended up in a recession have gone down, 40, 45, 55%, right? The last one, 2008, stocks fell 55% on the S&P 500. I believe it was 48% in the crash, the dot-com crash, even on the S&P 500, which is, the broader market outside those tech stocks. So stocks can still fall quite a bit further, and I do believe they will fall further. So you don't want to be using margin, because that's just going to leverage and amplify your losses. What I would do is, yes, as stocks do fall, maybe hitting that 3,000, maybe I would be all in cash at that 3,000 mark, right? That would be 37% down from the peak. That would be quite a ways, and probably one of the worst bear markets that we've had other than the last few. I wouldn't be using margin at that point either. I would probably be looking to make more money. I mean, here's a great opportunity to try some side hustles or passive income ideas. Make that money so you have it to invest at these lower prices. At that 2,500, so at the 3,000, I would be all in on cash. Maybe even looking for some of the other assets that I can sell. Selling my bonds, selling other assets, real estate stocks, things like that, to be able to put it into stocks and take advantage of those prices. At 2,500, at that point, I might start looking at margin, right? 2,750, 2,500, I might start investing a little bit more on margin, and to be able to take advantage of that, when stocks do start rising again. Because, again, at 2,500, that would be 48% down from the peak on the S&P 500. That's typically, 50% down is typically the lowest point that we see in these bear markets. So that's just one of the strategies. The other strategy, again, Michael Edison, Chief Risk Officer over there at the University of Chicago's Endowment Fund. He's using one called a value averaging strategy, right? This is kind of a mix of the dollar cost averaging strategy that he's using, and it's a little easier. It's basically you set a portfolio goal, for every month, for every quarter, and you just invest enough to meet that goal. Okay, so let me explain that. It's a little bit easier than it sounds. If you set your portfolio goal for $1,000 increase, every month, I'd say every quarter would probably be easier. So every quarter you say, hey, I want my stock portfolio to grow by $1,000. Now, so through that quarter, if stocks fell $500, or if your portfolio fell $500 over that quarter, then you would have to put in $1,500, right? You would have to buy in $1,500 worth of stocks to make up for that $500 loss. The amount your portfolio has decreased, plus that $1,000 increase, the target that you set, right? If conversely, if stocks increased over the quarter, if stocks increased and your portfolio is up $800 over that quarter, then you would only need to invest or buy in, buy that, not buy the dip, but buy the rally, $200, right, to meet that $1,000 goal over the quarter. Okay, so it's just another marker strategy, another way to know exactly how much to invest. Now, there are a few things that I would change about this strategy with this. So obviously, when stocks are going up, if your stock portfolio, if your target is $1,000 every quarter for stock portfolio growth, if stocks go up and your portfolio grows by $1,500 during the quarter, then this strategy actually calls to sell $500 worth of stock to meet that $1,000 target. Sell $500 of stock, maybe put it in cash or bonds or whatever. I don't like that, obviously, especially for the cash or for the tax reasons. You could incur a lot of taxes by just selling your stock. Plus, it makes you miss out on a lot of that bull market rally as stocks are going up. So I wouldn't necessarily sell stocks. I would, even if my stock portfolio went through that $1,000 target or whatever target you have set, I wouldn't sell stocks. I would just put that money. I would have a set amount that I invest every month or every quarter, and I would put that money in cash or bonds or some of those safer investments anyway. I would put that money in the safer investments. So when this, when a bear market does come around and stocks start falling, you have to invest, you have to buy that dip. Then you have money set aside for cash in bonds and in these other assets to take that out and invest in those stocks to meet that target. So it's a fairly simple strategy. Again, you're just setting a portfolio goal for growth whether it's every month or whether it's every quarter. I think a quarterly one is a little bit easier because it gives you 3 months to really get that money together to buy that. You're setting that portfolio goal, maybe $1,000, maybe $2,000, whatever that may be, and whatever your portfolio has changed during that quarter, you have to invest the rest to be able to meet that goal. So it's a great way to add a little bit of discipline to your buy the dip strategy. Again, I think the biggest risk here, the biggest problem with investors right now is they're watching the market every day. They're freaking out, stressing out over stocks, wondering if now is the time to buy, if stocks are going to go up now. And they're just going old before their time, right? You're watching the market every day, getting frustrated that you don't know when to invest that cash or how to invest the cash. And these two strategies, they just give you that formalized, disciplined approach, so you don't have to worry about it, right? With my strategy, you know exactly when you're going to invest the cash, and you just wait to that point. You don't have to stress out every single day watching the market. So a couple great strategies there as far as buy the dip. We will have a question and answer session, at the end here. I want to get into some of the stock market news and strategies and things I'm looking at this week, but we'll hit some questions there in the at the end there. I do want to open this up to the sectors. What I'm watching this week. Let's go to our near and dear trusty sectorspider.com. Again, this is sectorspider.com, the tracker tool there on that. Let's see so sectorspider.com, you go to tools, you go to the sector tracker. All you out there in the nation know I love this tool. It just gives you that big picture, really, of what stocks, what sectors of the economy are doing, how investors are seeing those sectors, and kind of how to invest in those. All right, so last week we did see 3 of the 11 stock sectors managed to close higher, even though it was a rough week for the rest of the market. Stocks in healthcare are only down 7.8%, right? So stocks in the healthcare sector up almost 1% last week, only down about 8% versus the 18% sell-off in the broader market so far this year. So, those healthcare stocks, especially the drug makers, the larger drug makers, I'm not talking necessarily about the biotech names or the smaller ones, but those larger established drug makers providing some real safety, in the market sell-off. And that's something we've seen in a lot of the recessions and a lot of the sell-offs in the past. And it makes intuitive sense, right? People have to buy their drugs. They have to buy their pharmaceuticals, whether the market is going up or down. So something to watch, the stocks in that healthcare sector. The big shock last week, obviously, was the sell-off in consumer discretionary or consumer staple stocks. Okay, both consumer sectors. Consumer discretionary down 7.8%. Consumer staples down 8%, which is just unheard of, right? We'll actually look at how bad that was in a little bit here, but a huge drop in both of those consumer stocks, obviously from all the earnings from Walmart, Target, and some of those, and actually that was despite consumer kind of retail sales coming out very strong, coming out about 8% growth year over year. So the consumer is still strong. We are just getting a lot of negativity, a lot of pessimism, and lowered outlooks from a lot of these retailers that is causing these stocks just to drop through a floor. Now, the S&P 500 is now back down below its 10-year price-to-earnings average. S&P is now trading for 16.4 times on a forward basis. That's versus about a 16.9 times over the last decade. So stocks are now under their 10-year average as far as valuation, under that 10-year PE ratio. Cheapest sectors, if you look at the relative valuations, energy stocks actually still, even after the huge run this year, energy stocks are still 36% below their 10-year average. And I think a lot of that is still just before 2014, energy stocks were extremely expensive. And so I think some of that valuation is still, a little bit, skewing the numbers there. But energy stocks are still below their 10-year average. Material stocks are down 14% from their 10-year average. So I think materials and industrial stocks right now are being beaten down especially badly. Obviously those are cyclical types of stocks. These are cyclical companies that tend to rise and fall along with the economy. So if we do get a recession, those are the ones that get hit. But material stocks in the material sector are down 14% from their 10-year average. Industrials are down 3%. So both of those sectors are relatively cheap versus the rest of the market. And, I did want to talk about the consumer staples sector. This is typically the sector that you go to for safety, and it was no place for safety last week, down 8%. We can click through here and see some of the biggest losers. Obviously, Target was one of the biggest ones last week. Walmart down 20%, Costco down 16%. Kraft Heinz down 13%. And these are companies that have extremely safe cash flows, right? You go to Walmart, whether the economy is good or bad, because you just need to buy the things they have, like Pop-Tarts. So typically very safe sectors, but the 8% drop last week, I actually looked this up. I guess the dinner's ready. Dinner's ready, so I got to go. But anyway, the drop in the consumer staples stock last week, 8%, was the sixth worst in over 1,200 weeks since the fund's inception, right? That XLP, Consumer Staples Select Sector Spider, started trading, I think, 1998. 1,200 weeks, and last week was the sixth worst week. Okay, all five others have been during market crashes. 2008, two of them during the 2020 crash. 2002 and 2001 were worse weeks than this. I think the worst one was like 13% down in 1 week. But the good news is now that the XLP was actually up an average of 5.6% in the following 6 weeks. Okay, so again, these are extremely cash safe and stable stocks. These are stock companies that they're going to make money whether we get a recession or not, whether the market goes up or not. So I think you do start looking at these for some of those value plays and safety, just in case the market does get worse. Against that weakness in the stock performances that we saw last week. Like I said, earnings and sales for these companies are still very good. 85% of the companies in the group beat their sales and earnings estimates for the first quarter, which might seem kind of counterintuitive, right? If 85% of these companies beat their expectations for sales and earnings last quarter, why did the stocks fall so much? Okay, and of course, it's just because they're being so pessimistic and so negative on the rest of the year, telling investors, telling the market that they don't believe that those previous targets that they set for sales and earnings will be beat. They believe they're going to be a little bit lower. And what I think is going on here, we've talked about this in the past. It's a game, folks. It's a game. Management plays with the market, trying to justify their $1 million paychecks, right? You see this every first quarter of the year, especially this year more so, just because everyone else is doing it. But they lower these expectations. They have to come in and say, we're doing great as far as sales and earnings, for last year, but we're a little worried about this year. We're going to try hard. We're going to try to grow this company and grow your profits as an investor, but we're a little worried. So we're going to lower our expectations, lower our outlook for the rest of this year. Well, what does this do? Obviously it hits the stock in this quarter. We see these big stock losses in this quarter when they say that. But then it makes it so much easier for them to meet those new lowered expectations come the second and the third and the fourth quarter. When those earnings are reported, then they come out and say, hey, look how great a management we are. We had that negativity. It was a tough environment for our business, but we were still able to beat expectations on those sales and earnings. So, give us our $1 million paychecks. That's really a lot of what this is, right, folks? And like I said, you see it every first quarter, but this first quarter, I think just because everyone is doing it and everyone is doing it to such an extent, companies are lowering their sales expectations by millions of dollars, billions of dollars, even in some cases, and they're getting away with it, right? They can't be blamed because everyone else is doing it. Okay, so I think a lot of this is a game, and I think it's just going to come through on support for the stocks when those actual earnings do come out, and the sales and the earnings are actually pretty good, much better than expected. So that's kind of where we are at in the sectors. You can kind of play around with this on there. Look at the year to date. Year to date, only two sectors after last week are up for the year. Energy up 47%, which even though we say that energy is still cheap on a 10-year average basis, still under that 10-year PE ratio. I think they've got to be getting a little expensive at this point, especially if oil prices do eventually come down. Utilities obviously playing that safety play, that safety sector for investors. Very stable stocks there. And then the consumer staples sector down. That 8% drop last week took it down into negative territory. Some of the hardest hits, obviously, the consumer discretionary, communication services, which is going to be a lot of your internet names, and then technology stocks have all been hit hardest in this. Now I want to talk about kind of what I'm watching for this week, some of the stocks I'm watching. Last week was all about the consumer, and this week it's going to be no different, right? We have a lot of retailer names reporting their earnings this week. Last week it was Walmart and Target. This week it's Macy's, it's Nordstrom, it's Costco reporting earnings this week. And probably more of the same as far as those lowered expectations. Again, because I think a lot of management is looking at this as kind of a no-lose situation, right? They can now throw everything out, throw the baby out with the bathwater, as they say, lower their expectations for the rest of the year on those earnings and sales, and not be blamed for it, right? Nobody is blaming management for lower their outlooks right now because everyone is doing it, because everyone is so pessimistic and so negative, on the rest of the year's earnings and sales. Which again is weird because the consumer is still very strong. Okay, we had those JP Morgan numbers out a few weeks ago, said consumer credit card spending up something like 16-19% year over year. Consumer deposits, savings deposits are up about 6% year over year. So, not only are people spending more money, but they're actually depositing more money in their savings accounts as well, versus last year. So the consumer still has a lot of money and is now spending it. So consumer, retail sales, like I said, retail sales came out last week, 8% growth year over year, which is very strong. So consumers are still spending strong. It's just a lot of these companies, they've started this trend of, hey, let's lower our expectations. Let's lower them by a lot so that we can beat those expectations when the earnings come out, for the second, third, and fourth quarter. So I do think we get more of the same from those retailer names, from Macy's, Nordstrom, Costco this week, and we'll talk about a few of those stocks this week. So we're also going to get the minutes of the most recent Fed meeting, the FOMC meeting on Wednesday. A lot of times investors like to look at that to see if they've changed any of their language, if they're closer to getting more aggressive on rate increases or less. Obviously we'll be looking at whether a lot of the Federal Reserve members wanted a 75 basis point hike or a 7.75% hike in interest rates during their last meeting, or if most of them are fine with that 0.5% hike. So how close are they to being more aggressive at interest rate increases? We also see the PCE, the Personal Consumptions Expenditures Index on Friday. That's the third inflation report we get of every month. First we get the CPI, the Consumer Price Inflation or Index. Then we get the PPI, Producer Prices, and then here towards the end of the month we get that PCE, right? And now, while this is the inflation report that the Fed watches, that the Federal Reserve, the central bank watches as far as to measure real inflation, it's usually just kind of an afterthought, right? Because, we've already got those two other inflation reports. We know pretty much how inflation ran on a year-over-year basis from those. So it's kind of a non-event for the market, honestly, a lot of times, unless there's any big surprises. Now, there is income and wage data in that PCE report that comes out on Friday. So that's important to watch, obviously, because a lot of these companies, they're pointing to those higher wages and that wage pressure as a reason for why they're lowering their expectations for the rest of the year. Those wage pressures really starting to hit the bottom line, hit that profitability at those companies. So we want to watch for that, want to see, how much wage pressure and wage increases are going to be weighing on the bottom line for stocks. I want to look at some of the stocks that I'm watching this week. A lot of kind of wrapping up on earnings this week. We've got about 90% of the stocks in the S&P 500 already reporting earnings. So this week is basically one of the last. Auto parts retailers. Now this is an interesting one. This is So we've got Advanced Auto Parts reports today on Monday. We've got Autozone, ticker AZO, reporting Tuesday, tomorrow. And the groups largely followed the market lower this year, crashing hard over the past couple of weeks, just on those fears of a consumer slowdown, right? So you can see here, Advanced Auto Parts was down 7% on Friday alone. All the auto parts stocks, O'Reilly was down pretty hard last couple of weeks. AutoZone was down as well, which is kind of surprising because all three in this space, that whole auto parts retailer space, did very well as one of the safety plays in the 2008 crash. Right? This is something we talked about in a video last week, actually, around stocks that did do well and actually good dividend stocks. You see here, Advanced Auto Parts pays a 3.3% dividend yield. Let's go to AZO, see how much they pay. I know all three of these stocks pay decent dividends. Nope, I guess AutoZone doesn't pay a dividend. Let's check O'Reilly, see what they pay. So we got Advanced Auto Parts, AutoZone, and O'Reilly. O'Reilly actually doesn't pay a dividend either. That's weird. I thought at least two of those did. But we'll go back to Advanced Auto Parts. I think they're the leader. They have a little bit higher market share than the other two, a little bit larger, $11 billion market cap, 3.3% dividend yield. So I would go with that one as far as the dividend. And again, if you look back in the 2008 crash and even past crashes before that, auto parts tend to do better than the market. Okay, and it's intuitive. Again, if we have a recession, people are worried about their jobs. They're not going to be buying new cars. They're going to be buying auto parts to fix up their old cars, right? So I still do like this group, even despite the hard sell-off last week. Again, on the fears of consumer slowdown, but I think this one is going to be a little bit safer than some of your other stocks in the market. Best Buy actually reports earnings on Tuesday with shares down 30% so far this year. So the electronics retailer, a lot of it this month again on that crash in consumer stocks. Market is expecting Best Buy to report earnings of $1.63 a share. That would be down 27% from last year's fiscal second quarter profits is what they're reporting is Q2. And folks, a lot of this, these companies, they're seeing lower earnings because the first quarter of last year or the second quarter for Best Buy was extremely good, right? We were getting another round of stimulus checks. People were still very much cash flushed. They were just getting out to spend their money, after the lockdowns, and earnings for all companies were up very high. They were up. What were they up? Like 27% last year as a whole. So very strong earnings last year. Of course, now we're starting to see things get a little bit closer to normal, and those earnings expectations are coming down. So $1.63 per share for Best Buy in earnings supposed to be reported. Again, it's hard to say, but I think you're going to see more of the same. I would expect management to talk about the same thing we heard from Walmart last week: the potential for more weakness this year, for that inflation, for supply chain problems, and I would be worried for a lot of these consumer retail stocks, even after they've come down so much, down 30% so far this year. But it's every time somebody has said something about these the earnings come out for these stocks, they've come down lower. Nvidia reports earnings on Wednesday. Shares are down 52% from last year's peak. Company is still reporting strong earnings growth, though. Actually expected to report $1.29 per share versus only 91 cents a share a year ago quarter. And I think it's likely to beat it. This company management manages those expectations for earnings in a way that they can come out and beat them no matter what, right? It is difficult to imagine what kind of positivity management can bring to this meeting, though. Okay, gaming and crypto have slowed considerably over the last few quarters, right? So the gaming segment, the crypto segment that was really holding up Nvidia and really pushing it to new highs, that has really fallen hard over the last couple of quarters. Data center business is likely to provide the only bright spot here. So, after a 52% drop from last week's peak, I think long-term investors still have a lot of reason to buy at this point, can still like this stock. I still, as a value investor at heart, I still just can't see it taking a chance at 16 times on a price to sales basis, right? So even after coming down by more than half from last year's peak, it's still extremely expensive, 16 times on that price to sales valuation. So I think I would be cautious here on Nvidia as well, unless you're that long-term investor that can just sit in the stock for the next 10 years, 5-10 years, and don't worry about these smaller bear market cycles that we just have to go through. Costco Wholesale Corporation, ticker COST, reports earnings Thursday after falling 15% last week. Obviously, Walmart came out with its numbers. It's got that Sam's Club component, which is very similar to Costco, reported those numbers and took Costco down 15%, just on the idea that what Costco is going to say this week probably isn't that much dissimilar from that. I'm actually a little more positive, though, on shares of Costco than I am on a lot of these other stocks. If you do look into that those Walmart earnings report, then Sam's Club, so Walmart's discount membership club, were the bright spot. So Walmart itself did poorly, but Sam's Club did very well relatively in those earnings. And I think that's kind of a good sign for Costco for what they could say. Now, no doubt, though, and this is the thing, folks. I think Costco earnings are going to be better than expected. They're going to beat those earnings expectations, and the earnings are going to be good. But you can't keep the management from saying something pessimistic, from warning on the rest of the year and lowering those expectations, right? Shares are already down 27% so far this year. Could be ready to surprise higher. What I think I would be doing here on Costco, since I am a little bit more optimistic on what their earnings actually come out as, I think if you want to go in here, I think you go in with half of your money here and then wait for what management says during the earnings report. Maybe if they bring those shares down lower on a pessimistic outlook, then you use the rest of your money, that other half of your money, to buy into the shares at the lower price. But I do think there is a potential to surprise higher on this stock. After last week's 15% drop. If they do come out with better than expected numbers, on the last quarter. Macy's also reports earnings on Thursdays, likely to sound the same warnings we heard from Target, right? At this point, I really don't see a whole lot of difference between Macy's and Target as far as operating performance and what they're doing. Shares fell 12% last week, both on the results from Walmart and Target. So kind of a stair step down all week last week for Macy's, down 12%, obviously down quite a bit, from its peak. And Macy's is really between a rock and a hard place, right? Between the poor retail environment right now, so between fears of consumer slowdown right now, Macy's is also just contending with that long-term slowdown in department store sales. And it's really something that I'm not sure they can win. They're trying to transition a little bit more towards digital, sell off some of those underperforming assets, but I just don't see it. They've been trying to do that for the last 5 years, and I just don't see it working right now. Finally, the dollar stores are also reporting this week. Dollar stores are reporting Thursday with Dollar Tree and Dollar General. That's ticker DLTR and ticker DG, Dollar General. Following, again, another tough sell-off last week. Both stocks were down 20% on Walmart's earnings release last week, continued to fall throughout the week. And again, it's a little bit not necessarily counterintuitive, but just off from what we've seen in the past. Dollar Tree is still outperforming the market with a 9% loss so far this year. That's about half of the drop we saw in the S&P 500 so far. And the dollar stores, again, typically provide some kind of a safety in a recession, right? We looked at that information, that same video that we did last week, looking at those stock performances over the 2007 through 2009 crash in stocks. And what we saw is all of the dollar stores, Dollar Tree, Dollar General, did very well during those periods, or relatively well, right? I think they still dropped a little bit, but not nearly the 55% drop we saw in the stock market. And it's obviously, because as consumers, they see a recession coming, or they start losing their jobs, they see unemployment rising, they start shifting their spending to get the most bang out of their buck, and they get it from these dollar stores, Dollar Tree, Dollar General. So again, this is one of those that, like the drug stocks, like the auto parts stores, I would look to start maybe picking up some shares here. If I was worried about a recession and stocks moving lower, these can provide some kind of a little bit more safety, in that sell-off. Last note we want to talk about before we open it up to question and answer, cryptocurrency. I see a lot of articles coming out. Inflation is up. Why isn't crypto up? Gold is up. Why isn't crypto up? Crypto is supposed to be digital gold. Crypto is supposed to be an inflation hedge. Crypto is moving along with high risk stocks. Why is it doing that when it's supposed to be a hedge against stock market risk? Well, folks, you know what? I mean, we need to talk about what Bitcoin and what cryptocurrency is and what it is not. Okay. Yes. Does cryptocurrency, does Bitcoin especially have some of these elements of an inflation hedge? Well, yeah, there's only going to be 21 million Bitcoin mined forever. That's a limited supply. So, as the dollar loses its value, then and Bitcoin is priced in dollars, then Bitcoin should go up, right? It is something like it does have elements of an inflation hedge. Is it digital gold? Should it go up when gold is going up? I mean, Bitcoin does have elements of as a store of asset, as a store of value, right? It does have elements of that. Is it a non-correlated asset? Should it be, something that diversifies your portfolio to help protect you from a stock market crash, right? Should it move, not necessarily in lockstep with stocks? It should, right? As another asset, it doesn't move exactly the same with stocks. And we've seen that to some extent, that it hasn't moved exactly a one-to-one correlation with stocks. But what we have to understand here is right now in the life cycle of cryptocurrency and Bitcoin, it is very much just a risk asset, okay? It is a risky investment asset, and it is going to do what all risky investment assets do when investors sell out of the market. When we have a bear market and they sell out of those types of investments, it's going to go down, right? In the newsletter that came out last week, I made the analogy of, it's like Thor in Endgame, right? Big Marvel nerd, right? So I got to use any kind of Marvel analogy I can when I can. And, in Endgame, Thor was having this big identity crisis of who he was supposed to be, right? He wasn't fulfilling that persona of the god of thunder, this almost near immortal demigod, protector of the universe, or the 9 realms, right, as they say. So he was, almost to the point of panic attacks because he wasn't living up to what he was supposed to be. And obviously, towards the end, he finally found out that it's not what he's supposed to be. It's what he actually is. And he just needs to develop into that and use that. And of course, we're going to see more of that in the upcoming Love and Thunder sequel to the franchise. If you haven't seen it yet, the end game, I mean, I don't know what's wrong with you, but check that out because it was some really good scenes on that. But I think it's a very, very close to what we're talking about with Bitcoin here. Okay, Bitcoin, we have all these interpretations of what Bitcoin is supposed to be: an inflation hedge, digital gold, non-correlated asset. But that's not what it actually is. Okay, someday it may fulfill those roles more completely. I think it will, especially as we start getting closer to that 21 million Bitcoin mined, getting up to that as it develops more into an asset class. It will have elements and it will fill those roles more completely. But right now, you have to know what Bitcoin is, that risky asset. As the market comes down, Bitcoin's going to come down as well. Okay, so understand that. Understand that all these other factors don't mean anything for it right now. Just invest as a risky asset, right? And that's how you invest in Bitcoin right now. I want to open it up to question and answer. Didn't get to do this last week because we had the recorded session. I love doing this and be able to connect with all you out there in the nation. So let's open this up and see what questions we have there. See, again, all you out there in the Bowtie Nation, I appreciate you being out here. Chase there, Danielle from Florida, Nella from DC. What else we got? Just looking here for some of these questions here. If you do have a question, make sure you go ahead and ask it and use a question mark so I can see that it is a question and I can see that. Opportunities. Make sure to hit the like button. I see Melanie's here. Good to see you, Melanie. I've been on so my question is, what are the best assets to buy? Okay, so Ricardo, the silver-eyed Lion King, wants to know what are the best assets to buy for inflation and hiking rates. Okay, something we've talked about on the channel before. So inflation, obviously, inflation at 8%. It is starting to actually come down a little bit. We did see the consumer price index reported this month was down a little bit from the month prior, not much, by like 0.3%. So not a whole lot, but we did see that start coming down. And I do believe we will start seeing consumer prices start coming down just slightly on that year-over-year basis, right? But here's the kicker. So we are going to see this consumer price index start coming down into 7%, 6%, something like that over the summer. I do believe that's going to be a relief for the market. We're going to get that relief rally on that drop in consumer prices. Maybe on the idea that the Fed doesn't have to raise rates quite so aggressively, but here's the kicker. Once it does start coming down, I think it's going to become clear very quickly that it's not going to come down to 2 or 3% like the Fed thinks it's going to over the next couple of years, right? So we are going to get high persistent inflation years out into the future. So you do need to be ready for that. Beyond this relief rally that we get as we start seeing consumer prices come down a little bit, you do need to be in those stocks and those investments that do provide that protection from inflation and higher interest rates. So so inflation. You've got things like real estate. Real estate typically does well. Now, residential real estate is fairly expensive right now, and we are starting to see that come down as the interest rates come up on mortgages. But commercial real estate is still you can still find some good values there. So not necessarily direct purchase of commercial real estate, but REIT stocks, so real estate investment trusts. So you look in some of those real estate stocks. You look in some of those. As far as higher interest rates, we got the banks. Now, obviously, the banks haven't done that well this year so far just because they're being priced in as a recession, right? As a recession is coming. The banks are falling because of, fears for a dropping loan demand, fears of higher default rates on their loans, things like that. But there's a balance there, whereas all these other stocks, a lot of other stocks, they're getting hit on those recession fears. They've got nothing to balance that out. Banks at least have that balance of higher rates, right? Because you know how banks make money. They take your money from deposits. They pay you almost next to nothing on those deposit rates, and then they lend your money out at those longer term rates. And those longer term rates are going up right now with higher interest rates, right? So with banks, at least you've got a little bit of a trade-off, between yes, the recession is bringing those stocks down a little bit, but they are going to be making more money through those higher interest rates. So you got the banks, you've got insurance companies that have a lot of cash that they need to reinvest in safe assets. Well, now they're getting higher rates on those safe assets that they're investing in. So you got banks, insurance companies, a lot of those financial companies basically are going to be okay. With higher interest rates, they are going to get hit partly by the economy, by a recession, but they're going to hold up relatively well. Okay. You also want to look at, just stocks in general tend to do well with moderate inflation. Inflation up to about 4.5% isn't bad for stocks. Okay. Once you get over 4.5%, 5%, then it does start weighing on stocks quite a bit, which is what we're seeing right now. For inflation, higher interest rates, things like that, things like real estate, things like, commodities longer term could do well, especially as some of the electric vehicle input commodities. I would look at copper. You look at obviously the battery minerals, the lithium, cobalt, things like that. Very strong demand over the next few years, and they keep up with inflation. They do well in inflationary environments. So great question there. Israel wants to know about SoFi. Thanks for that $10 super chat. I appreciate that. Something you got to understand about a lot of these growth stocks that we've been talking about so far this year that have come down quite a bit. SoFi in particular, these growth stocks, they're going to fall with the rest of the market, right? And they're going to fall harder, right? But that you have to look at these as those long-term growth stocks, okay? And you got to pick 3 to 5 of them that you really believe are changing the world in which we live in. And I think SoFi is one of those. I think Teladoc is one. I think SoFi is one. I think PayPal can still be, considered one, even though it's a little bit older company. But SoFi in particular, SoFi is changing internet banking, right? It's changing financial banking as we know it. And what SoFi's advantage is, something we've talked about on the channel before. SoFi actually has a banking license. Okay, a lot of these fintech companies, a lot of these online, digital banking companies don't actually have a banking license, right? So that means they can't offer savings or checkings accounts. They don't have access to some of the same lower rates that traditional banks have access to on their funding, right? The Fed funds and things like that. SoFi has that, right? So not only is it a faster growing digital bank and digital financial technology company, it also has that traditional leverage that it can use from that banking license. Okay. So I think that's really why you stay in SoFi at this point. I think SoFi, for a lot of the reasons SoFi is down is because of the student loan moratorium. Okay, SoFi started out as a student loan refinancing company. It's since shifted to a more inclusive financial technology company, but it still does have a lot of its revenue from student loans. Right, we haven't been paying our student loans for more than a year now. Okay, that's been put off till I think August. It's almost certainly going to be put off again until the rest of the year, because of the elections. Nobody wants to start making people pay their debts while they're voting, evidently. So there's still going to be some weakness there. But as soon as that student loan moratorium, or as soon as we have some kind of resolution to the student loan debt problem that they're trying to work through in Washington, then you'll see SoFi come up, right? So you're going to see that bump, over the near term, over the next few months, several months through next year, and then longer term. That's where I'm investing. I could care less what they do near term. Longer term, SoFi is going to be one of the largest banks. Okay, SoFi is going to be a very large digital bank. They've got that competitive advantage, and I think you stick with the stock here. Okay, I own the shares, and I'm buying more on these dips. What else do we have? Lower low next year than this year. I got to take some water here, folks. Deep salmon wants to know, should we expect to see a lower low next year than this year? Basically wondering if just save my money and invest in other things until the bottom next year. Okay, that's something we talked about there in kind of my strategy for the buy the dip, what I'm expecting, what I think we see. Again, I do believe we see some kind of a relief rally here into the summer. One, because expectations have been lowered so much. The market is so pessimistic. The American, I think it's like American Association of Individual Investors, right? The AAII puts out that sentiment survey for individual investors. It is at its lowest since March of 2009, right? Investors haven't been this negative since March of 2009. We see daily, companies lowering their guidance, lowering their expectations, really just destroying the stocks of their companies. We see a lot of negativity in the markets, despite some actually pretty good fundamental economic outlook and the economic backdrop, right? Retail sales still up, consumer spending is still good, deposits, consumer savings is still strong. You've got all these stocks are now no longer expensive as they were, and as we said, we're starting to see inflation come down with that April CPI number. Right, April reported into May. I think once we get the May numbers here reported in June, the CPI numbers, those are going to show another drop, and we're going to start seeing that CPI, that inflation, start coming down gradually. And even if it is gradually, though, we're going to see some kind of relief rally for the market through the summer, I think, and that does bring stocks up. Now, again, like I said, though, I have no doubt that we are heading into a recession because of the Fed. The Fed has a near imperfect track record for being able to raise rates so aggressively and not put us into a recession. All right, so I do believe, after this relief rally, we do get lower prices here heading into next year and into next year as we hit that recession. So again, I think the important point is it's nearly impossible just to time the market like that, though. So I think you need that formalized strategy of when and how you're going to invest. Otherwise, you're worrying about the market every single day. You're pulling your hair out if you got any left. And it's just no way to invest. It's no way to live. So you need that formalized strategy for when you're going to buy and how you're going to buy. That way you don't have to worry about it. You just know what you're going to do, when you're going to do it, and you stick with that. Okay, that makes sure that you have the cash left over to invest if the market does go down lower, but you are investing at certain points. So if the market does rebound from there, then you take advantage of that. The only way to do it, I think. If stocks get even worse from here. Hermes wants to know if the Fed could pivot on raising rates if stocks get even worse. We've had a few of the Fed members come out and explicitly say they're not worried about the stock market. They are not watching the stock market. They are exclusively watching inflation. And I think it's what they need to do, right? The Fed has two formalized mandates. Keep unemployment low, but keep inflation low as well. It can't be starting to worry about the economy and it can't be worrying about the mortgage market and the stock market and all these other things, because then that just kind of sets it up for conflicts of interest and for politicians to come in and say, hey, what are you doing here? You're supposed to be focusing on this, and you're talking about the stock market. So there's a little bit of a risk if the Fed does pivot and say, okay, you know what? We're going to head off. We're going to take our foot off the brake a little bit because the stock market is falling. Now that can happen. It has happened in the past. So I'm not saying that they won't do that, but it has to get a lot worse. Okay. The stock market would have to be down, I would say 35% before the Fed actually does start saying, okay, you know what? We are seeing some cracks in the economy, in the stock market, and asset prices and that kind of thing. We're going to let's take our foot off the brake just a little bit on raising interest rates. But it would have to get a lot worse before the Fed starts talking about that, right? Because it is now has to be totally focused on inflation. Everybody is saying the Fed is behind the curve. They missed the ball on this one so far on inflation. So it's really hurt the Fed's credibility when it comes to fighting inflation. Now they have to err on the other side. They have to say, hey, despite all this other stuff, we are singularly focused on inflation. So I don't think you can worry. I don't think you can count on the Fed coming back and saving the market. Okay. Here's a good question. Where was that? Okay, market is going to suck. How do you feel about 401k contributions through employee match this year? Should we cut back on the percentages altogether and hold cash? Great question. I'm glad you asked that, because no, never. Do not pull back on your 401k contributions. Please, folks, invest up to that company match. Okay. If you've got a 401k plan at work, if your company is matching a certain percentage of that, invest up to that match. Okay. Honestly, do not pull back on that. I wouldn't invest more than the match. So if the company says, hey, you put in 6% of your income, we're going to match that, then you put in 6% of your income. Do that 6%. Do the most, that top level for the match. Because think about it, folks. Even if the market does fall, you're getting, if your company's matching one for one, dollar for dollar, 100% match, you're getting 100% return immediately on your money. Even if they're only matching maybe 50 cents to the dollar. Okay. So most companies, they'll match 50% of your contributions up to like 3 to 6%, right? You're getting a 50% return immediately on that money. How do you beat that? How do you beat a 50% immediate return? Okay, and I'm just amazed, surprised, shocked all the time when people don't contribute up to that company match as much as they can, because that is a guaranteed win. You will never find another investor that can get a 50% annual return on their money, like that. It just doesn't happen, especially over longer terms. So no, please contribute as much as your company will match. If your company matches up to 6% of your salary of your income, put in 6% of your salary of your income, no matter what the market's doing. Okay, make sure you're investing that much to get that full match. Okay, that is going to be the best investment you ever made. Okay, selling stock is really important. Hi, Daddy, Rich Dad. How are you doing from NYC? Good weekend. Actually saw my Twilight Zone on Friday night, so I'm ready to start the new week. Whenever I'm not able to watch my Twilight Zone episodes on Friday night, it's hard to start the next week. You prefer to work from home or work in an office? Nolan asking if I prefer to work from home or in an office. I mean, obviously, work from home takes it on that one. I have gone back to renting an office several times over the past Geez, almost 9 years I've been working from home. So I have rented office space. I've had workers in my office, in an office space for a period before the pandemic. There's a lot of good things for both. I think more importantly than working from home is just having your own assets, your own business, and being able to grow that. If I was just working from home versus for a traditional employer, I think it'd be half and half. I think I would want to be in the office half of the week to make those connections, network, be able to get those jobs. Those job promotions that we are seeing don't come with that work from home environment. A lot of people working from home, they're not making the in office connections like they used to, and they're getting left behind. So it's one thing to consider. So I would want to be able to take advantage of that work from home half of the week and then working in the office for the other half of the week if I was working for a traditional company still. But good question there. It really happens in my case. Good to buy Target. Rocio wants to know if it's now time to buy Target, Costco, and Walmart. Target and Walmart both had their big losses last week. Their earnings reports probably not going to get any worse for those stocks. And again, that's they're good, stable cash flow stocks. I like Walmart a little bit better than Target just because I think it's obviously the leadership position. It's a larger scale than Target and larger scope as far as what you can buy and things like that. So I do like Walmart here. Costco, there is a risk because it does report earnings this week. I think there's a risk to both sides. I think there's the upside risk that the upside potential that it surprises and says something more positive than these other companies have. But there is also, this whole quarter, you cannot deny any risk in any company that management is going to come out and just say something horrible for the rest of the year and the stock is going to fall. So, it could be the best company in the, in the market. And if management comes out and says, hey, we're worried about the rest of the year, we're going to lower our expectations, then the stock is going to fall. So I would be worried about Costco. Again, I think there's upside surprise potential there because it has fallen and because, Sam's Club numbers did so well that I think Costco can do well also. So I think, maybe you buy in half here and wait to see what management says for the earnings to buy in the other half. But both of those, Costco and Walmart, good, safe, stable consumer staple stocks. They're going to hold up during a recession, right? So they're going to protect your money. And both of those, fairly good dividends. So I would look for that. Wow, monkeypox. Yeah, Danny, thoughts on monkeypox? Crazy new pox going around. I've seen the headlines. I haven't looked into it yet. I think it's fairly low transmissibility, and the case counts are so low that people really aren't looking at it yet. I'll have to look at it this week if it looks like it is spreading. But it's a crazy virus thing. Just looking at some of the pictures, that is nasty. So I'll be watching it, but I don't think it's anything to worry about just right yet. Amazon investors voting this Wednesday for the 20-to-1 stock split. So that's interesting. That's pretty cool. I saw Broadcom is acquiring VMware. Hadn't read into that, but I did see in the Wall Street Journal that Broadcom is acquiring the company. How to account for it while building up TSP Roth. So Nick wants to know any advice on figuring my VA disability rating into retirement planning. Not sure how to account for it while building up TSP Roth, etc. So your VA, so any kind of disability that you're going to get, pension. This goes for any kind of a guaranteed monthly kind of stipend or idea, right? Pensions, disability, anything like that. Basically, that is guaranteed income, right? So whatever you think you're going to need as far as expenses in retirement, you just take that amount out, right? I would put in a plug for the spreadsheet right now, but I don't want to get quite into that. There is a link to our spreadsheet, our portfolio spreadsheet in the description below. It actually has a page on it, a spreadsheet, a tab on it that helps you through that goal planning. How old you are, how many years to retirement, what are your expenses in retirement, what's your income going to be as far as Social Security, disability, things like that, and how much you need as far as your investments. Okay, so basically what you want to think about is you can take upwards of around 4%, maybe a little bit higher, maybe 4.5%, 5% of your investments each year in retirement, and that'll still last, a good 20 or 30, 40 years. you won't run out of money, right? So if you've got, if you need $20,000 a year after your disability, after Social Security, after all that stuff, if you need 20,000, 4%, so 4% it would be times 5, right? So yeah, I want to make sure or times 20, right? Times 20, 25. So times 25, 20,000 times 25 gives you what kind of portfolio value you need. So how much your investments need to be to create that 4%, which is 20,000, right? And I know it's kind of confusing just talking about it, but the spreadsheet lays it out. So if you need 20,000 times 25 is 500,000. You need a portfolio of basically about $500,000 to be able to take 4% of that out to be $20,000 a year, after your disability and after your Social Security, things like that. So it really comes down to, how much guaranteed income do you have? What are your expenses, and how much more income do you need to take away from your portfolio each year? So look for that link in the description. It's like $15 for the spreadsheet. Dinner or breakfast. Just got, yep. Proceed with delisting. Take 2. What else? SoFi, about more SoFi. Yeah, and we do see a lot of these growth stock CEOs, the insiders like SoFi, the SoFi CEO buying more shares here. They're looking at that long-term picture, on these growth stocks, on Teladoc, on SoFi, on companies like that, and they're buying shares, and that's just a support for the stock. Okay, Sector Spider. What else? Shorting Apple, Buffett buying more. Who will win? Yeah, okay. So Danny's talking about Michael Burry, the Big Short, right? Is shorting Apple. Warren Buffett is buying more. It's hard to see. I think Michael Burry, he's looking at the fact that Apple really hasn't fallen quite as much as the rest of the market has, and so there's a lot of talk right now. As I was watching Apple as kind of a market indicator, okay? When these big brand name companies like Apple, like Amazon, like Microsoft, those big beloved brand companies, when those start falling, that is really a sign of the last shoe to drop as far as weakness for the market, okay? And I think he's starting to look at that. He's starting to look at, okay, if we do get a recession, then everything's going to drop. Everything's going to drop harder, and Apple hasn't quite dropped yet, so he's shorting Apple. And there's also a point that I just don't see a lot from Apple's product cycle this year. If you're investing in Apple, you have to know that is a product cycle company. Okay, that stock very much ebbs and flows along with the enthusiasm behind the products that they launch every year. Okay, so is this year's iPhone something that people just have to buy, or can they have last year's iPhone and just wait for the next one? What are the new features coming out on this year? Is it updating its MacBook? Is it doing some of these other updates that people just have to buy? And honestly, frankly, I just don't see a whole lot in this year's lineup as far as the rumors around what Apple is going to release this year. So it seems the product cycle is a little bit weak this year. So maybe that's what he's looking on that. Buffett, obviously, just a longer term, investor, value investor. He's basically just buying up whatever he can buy right now. So Buffett is buying that. Not a big fan of Michael Burry, just because I think he's a whiner. He whines so much that people don't listen to him. His Twitter handle is even Cassandra, which is the Greek goddess that was her curse was she's right, but nobody listens to her, right? And so by making his Twitter handle Cassandra, it's a little bit kind of being a little whiny bitch, I think, right? Saying, oh, why won't anybody listen to me? I'm always right. Well, no, Michael, you're not always right. In fact, more often than not, he's so early that he's wrong. Okay, if you watch the movie The Big Short, he was like 5 years. He was calling for a mortgage crash and a financial market crash there in like 2002, 2003. And then we didn't get the crash until, 2007, 2008. So folks, understand, a lot of these people that are calling for crashes, in the market, and there's these bears and things like that, being early is just as bad as being wrong. If you do a Google search for a time-dated Google search for like years in the past, these people have been calling for a crash for years and years. and it's only now that the market is crashing that they're coming back out and saying, oh, look, I was right. I told you so. Well, no, Michael, you've been talking about this shit for the last 5 years. If I would have listened to you, I would have been out so much money from not being able to ride the market up higher over the last 5 years. So, just understand, all these people saying that they were right about a market crash, they were right, but they were right from, 5 years ago and would have lost you a lot of money. So not necessarily right about making money. What else? Just trying to get through some of these. How do you feel about bonds during this dip? Okay, Vape King wants to know about bonds during the dip. I actually like bonds right now. I do. I'm coming around to liking bonds once again. Interest rates have come up so much that bonds are now offering those attractive interest rates or those attractive yields. They're not going to fall quite as much as they did during the beginning of the year. Bonds, a lot of the bond ETFs like the BSV, the BLV are down something like 10-15%. And something you never see in bonds, right? Bonds are supposed to be the safe investment. They've sold off because of those higher interest rates. And I think a lot of that is priced in, right? And so at this point, I think you do get some protection and some yield in bonds. Now, what I would do, I would stick with like the BSV, which is the Vanguard short-term bond fund, right? The ticker BSV. They invest in shorter-term bonds, so they don't fall quite as much when interest rates increase. So you're going to get that protection. I think you get something like a 2.4% yield, dividend yield, which is a good yield. That safety, if stocks do continue to fall. So I do think you need some exposure to bonds right now. I think you need those savings bonds. We talked about those I bonds we talked about a couple of weeks ago. Definitely look into those. 9.6% interest rate, over the next 6 months, and probably about, probably similar 8.5-9% over the next 6 months after that. So you're looking at almost 10% yield guaranteed on a savings bond over the next year. I think definitely max out that. I maxed out that 10,000 on my account as well as my wife and kids. So a great way to kind of protect yourself there. What are you drinking? Drinking water, Angelo. It was really late today. Didn't have time to make my coffee, so it's water. I wish it was something else. I wish it was vodka. Okay, thoughts on Expedia. Expedia, I think it fell quite a bit on its earnings the last couple of weeks. I do like Expedia and some of these travel-related stocks, though. As we've been talking about on the channel over the last few weeks, consumer spending on travel-related themes, airlines, even cruise lines, but a lot of these other travel-related themes, hotels, online booking sites, things like that. Spending has been very strong. Okay, and I think it's going to continue to be strong through the first quarter, through the second quarter, and I think you're going to start seeing that in these stock prices. So yeah, I like some of those. I hate to say Expedia in particular because I haven't looked at the actual fundamentals and the valuation on it. But look at Expedia, look at Bookings.com, look at there's another one we just looked at a couple last week, I think. Look at Live Nation, the ticketing company. Okay, look at any of those, entertainment and travel related companies because the spending is very good on those over the last few months. Definitely would look at those. Any input on AA? Yes, if you need to go to AA, go to AA. Keep it, get your chip. No, Roman wants to know any input on American Airlines. Hoorah there, brother. As far as the airlines, again, I think as I said, the travel spending is very strong. So the airlines are actually reporting very good numbers. I think it was United that came out last couple of weeks that said their bookings is almost up to pre-pandemic, so they're doing very well. The thing that I've always hated about American Airlines is they have a much higher cost structure. Okay, so if you look at the actual, the number of seats or percentage of seats they need filled to be profitable, it is much higher than some of these other companies. Okay, so American Airlines needs something like I think it's like around 90%, 92% of their seats filled to be profitable on those planes. Okay, which they're just not getting. You look at some of the other companies. I know Southwest is much lower. Southwest is much closer to 86, 87% capacity that they need filled to be profitable. So, when I'm looking at the airlines, I'm thinking one of two things. One is I like to invest in the more profitable, the more efficient companies, right? So Southwest, some of those, right? Or, if you just want to play it as a trade, okay, for the traders out there, if you think that airlines are going to do very well, then the riskier ones, obviously the stocks are going to do better. Okay, so this is what you see. Generally, when you see airline stocks boom higher, jump higher, then American Airlines does better. Okay, because it is riskier, the riskier company, the riskier stock. So it falls harder, but it jumps higher as well. Conversely, the other stocks are going to provide you still that upside potential, but maybe a little bit downside safety, right? So something like a Southwest Airlines, it's not going to jump quite as high as American Airlines probably because it doesn't fall quite as far either. So something to think about in the airlines. Okay, American Airlines probably going to jump higher if airlines go higher, but it'll also fall harder. Whereas some of the other ones a little bit more stability and safety there. But I do believe airlines are doing well. Any Star Wars fans here? Kenobi coming out on Friday. Is that Friday? Now, and actually, it's weird because I hated the last three Star Wars movies. Kind of ruined me for the whole franchise. But I am really excited about the Kenobi series. I don't know if I want to watch it now. I want to wait till the more episodes are out because I hate waiting that week for the new episode. So I might let it go for 3 weeks. No spoilers, please. Might let it go for those 3 weeks, and so I can watch three episodes all at once. But yeah, very excited for the Kenobi series coming out on Disney Plus. Yep, and I would be probably long on Disney as well. Disney. Okay, so if we're talking about that theme of travel related and entertainment stocks, okay, Disney still doing well on the streaming, even though it's come down a little bit. But I think it's very competitive on that streaming. Maybe I'm biased because of Marvel and Star Wars, but they're doing well on streaming. They're doing well on some of their other assets, and now they've got the theme parks coming back. So I think Disney's a good buy here. I think it's one that's going to surprise higher on those theme park revenue and that kind of thing. And it's a good long-term stock too. Angelo wants to know if I think consumer spending will be slowed down by rising prices. No, not just yet. I don't think it is. I think people have been locked down for so long and have been under that kind of spending restriction for so long that they're just spending. They don't care what they're spending right now. I think last year we did see a little bit of pushback against higher prices. That's why we saw a lot of the consumer staples companies fall last year because they weren't able to pass on those initial inflation costs onto consumers. But what we're seeing this year is consumers, they know inflation is here. They know prices are heading higher. It's just a fact of life right now, right? So I think consumers are paying those. As we get in, maybe next year will be different. Maybe next year consumers will start to be, pulling back on their spending. But you got to understand with this whole with the whole spending idea is one, people still have lots of money in their bank accounts. For the most part, you might be broke, but most people on average, people deposit rates are higher. People are still spending, and house prices are up. So people feel richer because their home equity is higher. And the big one is employment. Historically low unemployment, 3.6% unemployment rate, down towards that 3.5, 3.4% historic low. I'm reading constantly. Read in the Wall Street Journal last week. It was something like, business companies are having to keep workers that they don't want. They're not firing people because they don't know if they'll be able to find someone else any better to fill that spot, right? There is such a shortage right now in available workers and a labor shortage that the companies just aren't firing people, right? So in that kind of an environment, it's hard to see consumer spending fall very far or very fast, because wages are going up. Unemployment is extremely low. People still have good deposit rates and low credit balances. It's just hard to see a bad consumer environment in that picture. Even with higher inflation rates, and which is why I think the market is going to be proved wrong over these next few months. I think the market is going to see, hey, consumers are still strong, inflation is coming down moderately, and maybe stock prices are a little bit too pessimistic right now. Okay, Pedro from Portugal. Hey, Pedro from Portugal. Good to see you there. Thank you for being part of the nation here. Dividend stocks, two stocks, Salesforce and Shopify. Which do you choose? I like Salesforce here. I like Salesforce as a long-term growth stock. It's actually one of the stocks in that free report that I tagged in the chat here. It's one of those good long-term growth stocks that I'm in. So I really do like Salesforce. I think they do well. Shopify is a little bit different, a little bit different animal. Obviously, they're e-commerce, exclusively, really competing with Amazon there. Really getting hit hard on one, the consumer, the fear of the consumer slowdown, but also the shift in the consumer. Over the last few months, especially, we've seen the consumer shift from those online e-commerce purchases that they did during the pandemic into getting those services and things that they can do out in the real world. So Shopify has been hurt from both of those angles. It's a good company, it's obviously got a good economy of scale, and it could be a good growth stock. I haven't looked at it very closely, so I don't want to say to buy into that stock. I do prefer Salesforce of the two though. Do you think Meta will keep dropping? Okay, so the Quags wants to know if Meta is going to continue to drop. And first of all, I'm not calling it Meta. It's Facebook. Okay, just like I'm not going to call Square Block and whatever else companies want to change their name to. It's still Facebook for me. But anyway, so Facebook, Meta, ticker FB. Will it continue to drop? At this point, I think Facebook is a good rebound play. I think the valuation is too low to ignore here. They still have, with Facebook, what I'm looking at a lot, and we talked about this, is of the social media stocks, Facebook is the only one with that kind of scope, right? Obviously it's got the scale. It's got like 3 billion monthly users, which is something no other social media site can touch. But it's also got the scope across different platforms. With Twitter, you're just getting Twitter. You're not getting anything else. You're just getting Twitter. With Facebook, you get Instagram, you get WhatsApp. So you've got 3 very strong platforms there. And WhatsApp is surprisingly strong outside the United States as messaging and that kind of thing. So I do like Meta here. I think the shares are a good valuation. Not to say it can't drop further. If the rest of the market drops, Facebook is going to drop as well. Okay, you're going to have a hard time finding any stock that isn't going to drop if the rest of the market drops 10 or 15%. Very few stocks out there. But I think, longer term, you look 5-10 years out, and I think Meta is a good valuation right now. Okay. Yeah, Danielle trying to reconcile comments regarding strong consumer and weak quarter at Target and Walmart. Okay, again, when you're looking at these stocks that are reporting earnings and the stocks are falling 10 and 15 and 20%, you got to understand what's actually happening here, folks. Okay, look at what their earnings and sales are that they're reporting. Both of those companies, Target and Walmart, did very well on their first quarter earnings and sales. Okay, they reported strong sales, strong earnings. Okay, what happened is management came out and said, yeah, but the rest of the year looks weak. Yeah, but we're going to lower our expectations and our outlook for profit and sales for the rest of the year. That's what destroyed the stock. Okay, the idea that investors are pricing in a certain amount of growth and a certain amount of earnings, and maybe they won't get that. So that's what destroyed the stock. It's not that these companies didn't make very strong first quarter sales and earnings. Okay, it's not that the sales, like I said, 85% of companies in the consumer staples sector are reporting beating those earnings and sales expectations for the first quarter. But the problem is they're coming out so negative and so pessimistic on the rest of the year that they're hurting those stocks. Okay. And again, I think a lot of it is just the game that management plays to justify those $1 million paychecks, those $1 million salaries, because management has to come out and beat those earnings expectations every single quarter, right? And that's a tough game to play. If you get too positive on your company, management's Management's got to be a cheerleader for their company, got to be a cheerleader for those sales and for those earnings. But if they get too positive, then it just makes it hard to beat those expectations, right? And if they don't beat those expectations, investors are going to find somebody that will and pay them the million dollar salaries, right? So management always has this trade-off between beating expectations for the previous quarter, saying, hey, look how good we did, but having to manage those expectations for the coming quarters. And that's really what we're seeing with a lot of these stocks, a lot of these companies. A lot of them management is saying, hey, we can't be blamed if we lower our expectations and we talk pessimistic about the rest of the year because everyone's doing it. Investors aren't blaming management for that. And it provides an easy route to beat over the next few quarters. Okay, the Quags says, do you think Citi and Citizens Financial are strong bank stocks? Okay, so Citigroup, ticker C, Citizens Financial, ticker CFG. Haven't looked at Citizens Financial in a while. It is, I have invested in it in the past. I've talked about it in the past. It's a fairly good bank, smaller bank, regional bank. Citigroup, it's one I own. It's one that we've owned in the Bowtie Nation portfolio for this year. We own it in there. Obviously, it got a big bump last week. I think Warren Buffett actually dropped his Wells Fargo shares and picked up shares of Citigroup, right? So a vote of confidence from Warren Buffett there. And it's really what we've been talking about on the channel for the last, quite a few months actually about Citigroup. It is just the valuation here is just very, very low. Price to book on Citigroup, I think is something like 0.65 times on a price to book level. It's got a good dividend. It's got a safe, stable dividend. And again here, you got to look at these bank stocks and say, okay, you know what? Yes, a recession will hurt their loan demand. It's going to hurt loan defaults, things like that. But those higher interest rates are a balancing factor there. So I really do like financials. And yes, Citigroup is one I've been investing in. And I think it's, even after last week's bump, I think is still a good value target there. Which Twilight? Okay, last with Cristobal wants to know which Twilight Zone do you watch? The classic. Okay. Oh, and also look up Night Gallery. Set the record. There is only one Twilight Zone. Only one Twilight Zone. It came out between 1959 and 1964. Had I want to say 156 episodes, all black and white, and it was the best show ever in the world. So no, that's the I've got all the episodes on DVD. I watch them every Friday night with a couple of glasses of Jack Daniel's Honey on the Rocks, and it kind of resets my week, right? Because I work minimum 6 days a week, usually something a little bit more on that seventh day. So if I don't have something to separate the week, Friday night, say, hey, this week's over, next week is starting, then it kind of runs together, right? So great way to kind of reset the week and watch a few episodes of The Twilight Zone. Night Gallery, I don't know what happened there. It's the same Rod Serling created, a lot of the same producers, even some of the same writers. And I've got those on DVD behind me too. And I've gotten through about half of them, just can't watch them. I don't know what it is. I think Rod Serling and some of the producers on Twilight Zone sold their soul to the devil to make awesome shows, and they just didn't have their souls left to sell for Night Gallery or something because they kind of sucked. But anyway, we are going to wrap it up for this week. I appreciate everybody for being here. Thank you. It's great being able to connect with you on the Bowtie Nation. If I didn't get to your question, ask it in the comments below. I'll try to get to it while I'm lifting later on. So I'm going to have lots of talk or lots of time at the gym to answer questions. Bullish on Talking Tina. Oh, so good. My kids love that. Kids are 9 and 5 and love watching Twilight Zone with me. They always, the first time they watch an episode, they're scared out of their pants, and then they watch it a couple more times, and they love it after that. But yes, I am long Twilight Zone episodes, long Twilight Zone futures, and buying up that as well. So again, thank you for being here. I appreciate it, and I'll see you next week.